I've been trying to contextualize this for people of like just what we're talking about when we talk about 20 million barrels or 20% of global demand, global supply in this case. But in COVID, in the depths of COVID, in March and April of 2020, we lost roughly 20 million barrels of demand globally at peak. So what we're talking about is if the Strait remains closed and if we need demand destruction to balance that equation, we will basically need to recreate COVID era demand destruction. When you and I were all locked in our houses, there wasn't a plane in the sky. I was still, wiping Amazon boxes down with Lysol wipes. That's the kind of behavior we need to reinstill, but with no pandemic, just through price structure.
RenMac Off-Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off-Script, where we openly discuss markets, economics, policy, history, and life. It is Thursday, March 12th, 2026. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Pavlik.
And I'm Rory Johnston.
Rory, busy lately?
It's been a very busy stretch. I was just saying, I didn't think it could get busier than early January after Maduro was captured, but here we are, and let's see what comes next.
Here we are. So Rory Johnston, leading independent oil expert and founder of Commodity Context, a research platform focused on the energy markets. He's an advisor to investors, global policymakers, and corporates on global oil dynamics, OPEC policy, and market fundamentals. He's a lecturer at the University of Toronto's Munk School of Global Affairs, host of the Oil Ground Up podcast, and a fellow at both the Canadian Global Affairs Institute and the Payne Institute for Public Policy at the Colorado School of Mines. And he's got a lot on his plate. So really appreciate you joining us this morning. So I need to probably timestamp this. It's 8 a.m. on Thursday the 12th because things are moving so quickly. So that's where we are. Rory, maybe we start with you. Just sort of give us a state of affairs in the Gulf, why you think $200 a barrel oil isn't off the table, and what that means, and what possibly we can do to offset that.
Yeah, so thanks for having me on the podcast, guys. The situation in the Gulf is that things have not gotten better. In fact, every morning I wake up, it feels, what was it, a year ago around Christmas, where you would wake up and you were, how many more Houthi attacks in the Red Sea there were? Like that was the morning routine, at least on my end, of like, okay, what's the state of shipping in the Red Sea? It's like that now in the Gulf, but instead of like attacks, it's, there was a large explosion at a U.S. flag tanker this morning. Last night you got, or I guess yesterday afternoon, you got large attacks, seaborne drone strikes on two tankers that weren't even trying to transit the strait. They were just parked off of the coast of Iraq. The situation continues to get worse, and it doesn't seem to be getting any better despite the attempted jawboning from the White House. So I think the question for this will fundamentally remain one of duration. How long is the strait closed? And once it opens, even after that, there's this long drawn out period of supply chain unwinding that's going to be very similar to when we were attempting to unwind from the supply chain bottlenecks and the kind of bullwhip effect coming out of COVID. You have oodles and oodles of tankers on both sides of the strait now that are all going to be trying to load and unload at the same time. You have product dynamics in Asia that have already begun to reflect acute crude scarcity because these refineries are essentially turning down activity in anticipation of the crude scarcity so that they don't actually run out of fuel or feedstock and they have a longer runway. So yeah, it's a complete mess, and it's truly wild to me that we are currently, as we speak, under $100 a barrel. There seems to be just tremendous drawboning coming out of the White House and anyone that has a vested interest in this war continuing, because obviously I think everyone knows that the oil price is the single most sensitive kind of pressure point for the White House and for President Trump. So as long as you keep that down, the war can keep going. But as soon as that keeps creeping up, you're going to continue to see kind of, shadows of Taco or whatever it's going to look like. That is still my base case going forward, is that he's going to back out. But then it's a question of, okay, even if he backs out, how long does it take Israel to stop? How long does it take Iran to stop kind of making an example of the strait? So happy to talk about all of this because there's so many elements to cover.
So does Iran have control over the strait, Rory?
right?
Sorry,
like
what? Sorry?
Do they have control over the Strait of Hormuz? I mean, I think I was reading, I don't know what's real and what's not anymore, but they apparently cut a deal with India to allow Indian tankers to go through. Like, obviously, if they're able to do those sorts of things, that means they have more control over the Strait than anyone on our side is willing to admit. So,
yes, certainly. I mean, we've seen these deals before. For instance, there have been similar discussions of deals with Chinese firms that China could still ship through the Strait. And yesterday, there was a ship that basically attempted to make the run through the Strait, a Chinese ship, and basically got attacked and basically did a U-turn halfway through the Strait and came back. So I would say part of the challenge here is that the kind of fractured nature of the Iranian regime and whatever remains of the government per se there is you have, one branch of this regime might be making deals, whereas the field commanders are still launching kind of missiles and drones at whatever ship enters the Strait. So I would say that it seems likely, and we saw this with the Houthis, a year and a half ago as well, that they were willing to make deals. And I think that particularly given the importance of China in particular and India to a lesser degree, but still to the Iranian trade, I think that's something that they'll probably be open to entertaining. It's just whether or not they can actually stick handle the tactics of managing that on the ground.
How long does it take to turn a tanker ship? I mean, that's kind of the old adage, right? Like, it's a slow moving tanker that you have to turn. Like, how long does it take to turn?
Honestly, the Chinese ship, I think it was a container ship, but it turned like shockingly quickly. It was like a little bit of like a Leroy Jenkins, and it was like no, and then like that baby gift, they kind of ran, turned around and ran away. That was what it was like, and it was like, yeah, I guess when you start taking fire at the front of your ship, you're just like nope, and then you just turn around. So I would say I would have thought it would take them longer, but they seem to. If you have a strong incentive to do so, you can get around pretty darn quick, I guess.
Right. Everybody on the left-hand side. Everybody on the left-hand side.
So, Rory, there's
row.
Right. There's about a fifth of the oil every day flows through the Strait of Hormuz, right? So that's 20 million barrels. Give us context. I know it sounds like a lot, but is it in the context of everything?
It's one of these things. It sounds like a lot, and then the is it question is actually more. It's actually bigger than you think it's going to be. And I've been trying to contextualize this for people of like just what we're talking about when we talk about 20 million barrels or 20% of global demand, global supply in this case. But in COVID, in the depths of COVID, in March and April of 2020, we lost roughly 20 million barrels of demand globally at peak. So what we're talking about is if the Strait remains closed and if we need demand destruction to balance that equation, we will basically need to recreate COVID era demand destruction. When you and I were all locked in our houses, there wasn't a plane in the sky. I was still, wiping Amazon boxes down with Lysol wipes. That's the kind of behavior we need to reinstill, but with no pandemic, just through price structure. And I don't know about you, but it would take a truly eye-watering price at the pump for me, not to drive my kids to school in the morning. I'm deeply, deeply price insensitive there. So then it becomes the question of, okay, well then how high does it go and where is the demand destruction going to occur? Because you and I and wealthy countries are going to feel this as acute pain at the pump. This is where we dive right back into your edge of the woods. It's going to sap consumer disposable income. That's going to cause all those kind of recessionary fears that we normally associate with oil price and energy price spikes. But it doesn't stop there, because while we can afford those high prices, emerging markets and poorer countries, even if some people in those countries would be able to afford them, the average consumer can't. So they're not going to be able to incentivize kind of balancing import cargoes to their shores. So we're going to see price spikes. They're going to see outright physical shortages, which in many of these countries would be like a deadly proposition. So I think that's the way this market's going to solve, kind of through the ruthless price mechanism of like a capitalist market. But it's going to just be very, very different depending on where you're sitting as to where this is actually going to land in your own kind of personal history.
So perhaps recessionary for the developed nations, depressionary for the developing nations.
100%.
Hold on, Steve. Let me ask this one question, because, this is a probability business, right? Not a prediction business. Right now, as I look at, say, the vol surface, right, of crude, it's pricing a conflict duration of roughly 3 to 5 months. So somewhere in a resolution somewhere between June and August of 26. Are you consistent with that, or are you different than that? Because that's where the real opportunity lies, right? If you're consistent with that, then the market's pricing it in. If you're seeing it differently, how do you see it differently? Because that's the opportunity set, and that's what I'm interested in as, obviously, a speculator.
I think while the vol might be pricing that, I still don't see that being priced in flat prices or even kind of term structure. That when we're seeing, if let's say this lasted 5 months, we're losing, even let's just be super conservative, 10 million barrels a day. Let's take half the headline number. We're losing 10 million barrels a day of supply. That's 300 million barrels a month. So that's 1.5 billion barrels over kind of 5 months. That is an untenable amount of demand loss, which is why I think those prices are inventory draw. So that's why those prices are going to have to grind higher, which is why myself and every other analyst is like flabbergasted by the fact that Brent is kind of still sitting under $100 a barrel. And I think I would say that while the vol service might be pricing a 5-month duration, I would say most of the oil market, most of the oil complex just continues to price a relatively rapid, cessation of these hostilities and resumption of traffic. Because like we were saying, like there's also, when we're talking about the turning the aircraft carrier or the tanker, it turns slow. I think part of the fear that I have here too is that I still expect this to end when Trump just suddenly declares it done. But then there's the question of he's not the only participant in this war, and he's not the only incentive structure that matters. Obviously, Israel will want to continue. Whether or not Trump stops and whether or not Trump can pull back Netanyahu, I think are very different questions. And as long as Iran is being bombed, it has every incentive to continue to sink the global economy, because it's proven now that it's very effective at doing so. We've talked about the potential for a closure of the Strait of Hormuz, as long as I've been an oil analyst. And honestly, it was kind of it's the boogeyman stories. You kind of doubt it yourself. You're like, well, surely they wouldn't be able to pull it off. Surely the Chinese would come in. Surely, something would happen. But then you just see it being speed run in real time, and it's just truly insane. Even if we can get escorts in there, we don't need to uptick the traffic through the Strait of Hormuz. We have probably about a 95% reduction in regular traffic. We need to 20x that. Even a 50% flowing Hormuz is still an existential crisis to the global economy. That's just how much oil flows through the Strait.
So, so right now, and I just want to contextualize this. 3 months out, June contracts, you're looking at $85 a barrel. You think that is ridiculously optimistic?
I would say it's ridiculously optimistic. I think even if it ended now, and I think part of the challenge here is, while I do think that current price formation and what we saw in the commitments to traders data last week, so last Friday, it's pretty stale now, given that was only in the first couple days of the crisis. But we actually saw speculators bail largely on the market. We saw gross length and gross shorts kind of plummet. We saw a mild net uptick, but based on the normal kind of price relationship, which is usually pretty tight with movements in managed money positioning, we would have expected upwards of 200 million barrels of net length addition in COT and managed money contracts. And we only got 6.5 million. So that for me is evidence. And when you look at kind of the relationships on the chart, it just stands out like a sore thumb last week. So this is what tells me that we saw this during 2022 as well. We saw the vol spike up. We saw kind of cost of carrying these speculative positions explode. Everyone bailed. And the only people that were left were essentially physical participants scrambling to try and source barrels. So this is in the academic literature, you talk about this as precautionary demand rather than speculative demand, that this is a refiner trying to be well, I can't be short, so I have to get this barrel now in the spot market. But I think what's really crazy is that there is still a speculative element here, because there's the speculative element of those physical participants, how long is it going to last? This isn't just a 3 million barrel a day loss for say a month or 2 months. We don't know yet. So physical participants are also wanting to not remain offside. So there's still some ability of the White House to jawbone prices. But I think when the rubber's really going to fundamentally hit the road is, so we're now 13 days into the conflict, give or take. That's roughly 250 million barrels of air gap that has now emerged on largely the exports out of the Gulf, largely headed to Asia. 2 weeks ago, those tankers were still leaving laden with crude. It takes them a month to a month and a half to reach their destinations. So that means we probably have, 2 to 4 weeks remaining until that air gap really begins to land in Asia. Once that happens, Inventories begin to draw down very rapidly. And then the physical market is going to push physical premiums well above paper markets. And that's what's eventually going to pull us back up. So as long as there is some sentiment here and the White House can keep talking it down, I think that's going to work. But if you do get those, truly aggressive, and if we're talking, 10, 15 million barrels a day of crude, inventory draws across Asia, like that's never happened before. So if that happened, you're going to get scrambles. And while the epicenter of the shock is going to be in Asia, what's going to happen in the United States? So you guys are largely US based. When US obviously produces the most oil in the world, large exporter, major source of imports is from Canada. So, but the remainder, about a third of the imports are other seaborne barrels that aren't tied into the US system via pipelines like the Canadian exports are. Those barrels are going to face exceptional pressure to come to Asia. So you're going to see massive premiums emerge for Asian benchmarks. You're going to see that ARB trying to incentivize westward or eastward flow, depending on which way you're going, in order to fill those gaps. And it's only then when you're going to start really feeling, like US refiners are going to really start feeling the pain. We've already started seeing, for instance, I was mentioning earlier that I didn't think I'd get busier than January with Venezuela. When that happened, and a lot of what I follow is Canadian crude markets and Western Canadians like heavy differentials at the US Gulf Coast. When Venezuela happened, those collapsed. The pricing for Canadian heavy collapsed in the US Gulf Coast because you had this large, all of a sudden available supply of Venezuelan heavy crude. But what we saw when the Strait was closed was those physical premiums tightened up exceptionally quickly. And basically people started bidding for those barrels. So the differential went from $8.50 at its kind of bottom back up to $1.50. So that's a big movement in WCS kind of, and that's quality on water differentials, which is again, one of your signs of attempting, like the Asian demand attempting to bid those barrels away from the US Gulf Coast elsewhere.
So are there things, given the fact that we're a big oil producer, that we can ramp up production and we can do the SPR and the sanctioned nations all of a sudden coming back online? Yep. Is that's not enough to fill this void?
It's not enough, but it'll help. And I think it's important to note that the Western Alliance, the kind of advanced economies, aren't help this here. I think, for instance, like you mentioned, the SPR, let's start there. What we've gotten so far, the IEA has coordinated a 400 million barrel SPR release. That is the largest in history by more than double. The last one was 172 or 182 million barrels in 2022. This is double that size. Over 170 of those are coming from the United States. That will help. But that 400 million barrel number is the total kind of cumulative volume. What's really going to matter here for this crisis is the flow rate, or the kind of simulator or substituted supply coming into the market. US, Chris Wright has said that 170 something million barrels is going to come out over 120 days. It works out to roughly a flow rate of 1.4 million barrels. Let's say you use that as representative for the entire flow. So that 400 million barrel release is like 3 million barrels a day of supply. That's a lot of oil. That's the volume that we feared losing in 2022 when Russia invaded Ukraine. That's a very, very large supply boost, and it shouldn't be diminished, but it still pales in comparison to kind of the 15, 20 million barrels a day of supply lost in the Strait. I think the other important thing here is what shocked me is how long it's taken them to act on that. Again, we're 2 weeks into this basically, and we're only now beginning to do an SPR release. If the White House had any plan here, if they had done any preparation, this would have been locked down. They would have had this ready to go. And it was very, very clear they didn't. You saw that, they clearly had no plan generally for oil at all. Like, it's the one thing that if anyone, your first year intern at the National Security Council is like, we're going to invade Iran, what should we watch out for? Well, they're probably going to do something with the Strait of Hormuz. It's like, oh, wow, I'm deeply shocked. They didn't do that exercise because very clearly they did not expect it to be in it this long. Neil?
If I was an intern at the NSC and the scenario was drawn up about bombing Iran, I would be worried about my hookah supply, actually. But Rory, I wanted to ask you a question. So what's interesting to me is and I'm sure you've seen this. So we have this energy shock, and it's a significant shock. And it feels like the research and the sort of view coming out of Wall Street, it's like the same sort of boilerplate, right? Which is, well, we're a big producer, therefore it's only going to knock, like everything knocks GDP by a tenth. COVID, a couple tenths. Government shutdown, a few tenths. Now this, a few tenths. And there's this sort of, I guess, assumption that we're kind of insulated from this. And, I've been arguing that it's a very kind of tricky time, but I guess my question is, at a more basic level, like if American politicians can't bear the political cost of something like this, even if we are the world's #1 producer of energy, so rising prices is a positive terms of trade shock for the US now in a way that it's never been the case before, then who is going to be able to bear the political cost if it's not us, right? Like, no. So... Like, in other words, like it was sort of sold as like, oh, this is making us more secure and so forth. But is it really, if we're not willing to, if we're this sort of, at risk of an energy price shock?
Well, see, Israelis are the ones.
Russia.
Well, and I was going to say Israel, but yeah. They can bear it.
I would agree with what you just said entirely. I think the single greatest beneficiary of this is Moscow. We've seen that in so many ways. You've seen Russian discounts on their crude implode or kind of narrow by $25 a barrel or more. India had been shedding Russian imports in dramatic fashion following basically from October to January. You saw between the blocking sanctions that OPEC put on Rosneft and Lukoil, and then the retaliatory tariffs the White House put on India for its import of Russian crude, that was enough to basically shave more than half of Indian imports of Russian crude between October and January. So that was actually going in the right direction. Russian oil water was building, discounts were exploding. That was actually going the exact way that you would want. And actually the White House was doing a very, very good job of putting pressure on Moscow. This undid all of it overnight. Basically, all of those suppliers jumped back into Russian barrels. You've had pressure even in Eastern Europe to push to reopen flows on the Druzhba pipeline, which is the pipeline that's largely been shut since the invasion of Ukraine and since the ban of import products into the EU. So Moscow, I think, is the clear far and away winner, to the point that the White House actually gave an explicit sanctions waiver to India to import Russian crude to basically help ameliorate some of the supply crisis. But Neil, to your point on the U.S., I completely agree. We saw this a lot even when I used to work at a bank and do like enterprise-wide stress testing, and the same thing for Canada. Like, well, if the oil price goes up, well, Canada's economy must explode or rise really quickly. But of course, the economy is more than just the export side. Even in Canada, there's a very, very large net exporter of petroleum. And while Alberta would boom, Ontario and Quebec would basically wither on the vine. And I think the same thing it would be true for large parts of the distribution, like regionally for the United States. Yes, it would be a big boon for Texas, Louisiana. I think this would be a massive shot in the arm for a shale patch that was, by all indications, looking like it was going to begin contracting in kind of structural form this year until this shock happened. So that's a huge boon. But in terms of an offset, I usually treat about a 6-month window between price movement and kind of movement to production levels. You've got a lag between prices and drilling, and then between drilling and completion, and then completion to actual production. But normally I say about 6 months. Let's say this is exceptional. It's 4 months. That's still, again, that goes back to the point about the market pricing. Let's say 5 months of this war lasting. If that happens, and we see U.S. supply jump gangbusters, by the amount it's done more than, a history before. I think the peak was over 2 million barrels a day of liquids growth year over year. That's a truly astonishing volume of oil. But even that is, again, that's only a drop in the bucket relative to what we're trying to fill in for. So yes, I think it would be a boon for the oil patch, but we would see, if this continued at that pace and you kept this for 4 months, we would easily see all-time high gas prices at the pump, not just what we saw in 2022, but like literally blowing past it very, very quickly. Because we've also talked about oil, and I think the easiest heuristic is to talk about like what price of oil will incentivize demand destruction. And I think that is roughly best, and I think it sorts it over time. But I mentioned right now that the product markets are front running what we're seeing in crude. And that's because the refineries, again, that air gap is taking, 2 to 4 weeks to get to Asia, let's say. The refined product market is tightening up already. You saw jet fuel last week trade over $200 a barrel equivalent in Singapore. And it's going to be product prices, not crude prices, that actually force demand destruction. So I think that's what we've seen. Diesel margins, middle distillates generally. So you've got diesel, gas oil, and jet fuel. They were already the tightest part of the refined product market going into this crisis. And we saw them explode exceptionally during the 12-day war in June of last year as well. But that's the area that's going to continue tightening. So at its peak in 2022, when we had the kind of COVID and the refining crisis and everything happening all at once, we saw crack spreads hit around $80+ a barrel for diesel. We were already at 60 here, and this is still going. So I think we could easily push past that. And that's, I think, going to be the part that's just really, really going to pinch.
Hey, Jeff DeGraff here. If you're enjoying Off-Script, you're going to love our free RenMac newsletter. It's quick, it's concise, it's got several of the charts that we're mentioning here on the podcast. We cover markets, policy, economics, and of course, strategy. It's quick, it's easy, it's insightful. It drops on Friday afternoons. If you want to get yours, go to the show notes, sign up there, or go to renmac.com/newsletter. Now, back to the show.
So Neil, Rory's talking about, potential price increases that cause a recession here in the developed countries in the U.S., right? And depressionary elsewhere. So we've got, demand destruction, but you've got inflation, you've got problems at the pump, et cetera, et cetera. So it feels a lot like stagflation to me. What's the Fed going to do?
Well, right now it just ties the Fed's hands, unfortunately. I mean, I think what's interesting about this energy shock and previous ones is that you aren't getting like a financial market shock absorber. So typically when you have some kind of a geopolitical crisis, longer term interest rates fall. They've generally been rising during this period. The dollar weakens. You're not seeing that. People are fleeing to safety and the dollar's getting bid up. Also, obviously, because we are now a net exporter of energy, I mean, the dollar has taken on petrocurrency-like dynamics. So when the oil, right, so it's almost a twofer for the emerging markets, right? I mean, not only do they have to deal with the rise in oil price, but obviously because they have lots of dollar-denominated debts, the rise in the dollar also makes them worse. And, as I'm sure Jeff can speak to, EM, Korea, Taiwan, that's been a big driver of the boom in global equity prices over the last number of quarters. I think for the U.S., consumers react, I think, in a fairly linear way to oil price spikes. Like to Rory's point, like he's not going to stop driving his kids to school because the oil price is, right? So it's sort of inelastic in the short run. But there is going to be a point where then consumers take on a much more sort of nonlinear response to, to their spending behavior. And that to me is the concern. On top of all that, keep in mind that we didn't have much momentum in the economy going into all this. I mean, there was a lot of enthusiasm for OB3, AI, CapEx, and the rest of it. But in truth, we've been shedding jobs, over the last number of months. I mean, basically seeing no growth in employment over this period. So we don't have much income growth organically for the U.S. household sector, and that's a problem. And as I've said, the fact that interest rates are going up at a time when it's about to be the spring selling season, not exactly the best combination. So
Neil, you're talking about the economy with some cracks below the surface, and Jeff, you had a note out to clients this week about that sort of the same framework for the markets, right? That there were some cracks emerging. Yes, it's good to focus on Iran and the oil situation, but there were some things underneath the surface that didn't look that good.
Yeah, I mean, we've been talking about that for 6 months, right? I mean, this was a trend market, not a momentum market. And all that does is it makes you susceptible to exogenous events, right? It's like going out on the weekend, not getting much sleep, coming back on Monday, and your cubicle mate has a cold. Well, guess what? You're probably going to get a cold because you're run down and your immune system just isn't there. It's the exact same thing. So I actually think the most interesting thing in this whole dynamic has been the inability of gold to muster a rally. That to me speaks to the bubble call that we made back in October that, we're getting into an environment, and all that really means is that, when you suck the oxygen out of the room, it takes a while for the oxygen to get back in the room, right? And everybody in the room just doesn't probably make it out. And that's kind of what bubbles do. And so, to me, if you kind of think about it, what the hell is it going to take for gold to make a new high if we shut down oil and, we've got a war in the Middle East and gold can't make a new high? I'm like, well, okay, that kind of says it all as far as I'm concerned. So the troubling thing for me, I'll tell you what, if Rory ends up being right, or even say half right on some of this, EM has not priced this in, right? Equities haven't priced this in. Oil hasn't priced this in. There's a lot that hasn't been priced in, which will be interesting. I will say the one thing that I found curious this week was the Consensus Inc. data. It actually has a good T-stat to forward returns on crude oil specifically, where bulls were only 56%. I would have expected bulls would have been, and that speaks to, I think, Rory's point on the commitment to traders data with speculators. I would have expected the bulls to be somewhere in the, say, mid 60s, high 60s, maybe even 70% by now. And they're just not. So, there seems to be that disconnect. In terms of the overall equity market, I would say EM and the MSCI ACWI ex-US, that's the All World Country Index, that's what ACWI stands for, got oversold. It bounced exactly as it should, so that was good news. And now we're right back into these kind of resistance points, so that will be interesting. The US never got oversold, not on an equal weight basis, not on a cap weighted basis, not internally. The percentage of issues above their 20-day moving average didn't get down below 20%. So we've got more work to do in our view of, creating some type of a low. Interestingly enough, and I think we talked about this last week, the only real data that looks interesting from a sentiment standpoint is skew. And that's just the difference in volatility between front month and 3 month out. And that has a lot to do exactly with what Rory's talking about, right? Or what the market's perception is, which is, hey, man, if this is a mess for a month or two, then we're going to price out vol. If this is going to get resolved in 3 or 6 months, then, things will be cool as we get back into the early summer. And if that doesn't happen, then you're going to start to see that shift. But interestingly enough, the put calls haven't risen. We did get a contraction in bull bears last week, or this week, I should say, but not meaningful. We still have more bulls than we quote unquote should, given the returns from the equity market. So I think there's more to go here from our perspective. What I would say in energy specifically, and Rory would probably disagree with this, from a behavioral standpoint, the trends in energy are strong. They frankly have been strong. They've been stronger globally than they have in the U.S. But they've been creeping higher well before this was going on. In fact, they were the strongest. That was the strongest sector in Japan, and I think it was the strongest, maybe the second strongest in Europe before this mess kind of developed. That said, what we're seeing now in the U.S. is excess inflows into the ETF. So behaviorally, retail investors are starting to jam their way into it. And in the options market, specifically for energy companies, we're starting to see a buyer's frenzy, right? And what that really is we've got momentum, but the expectations of the momentum going forward are above and beyond the already great momentum that we've had. And usually when you kind of get that, it's people, climbing over each other to get exposure. That doesn't usually end up working out well. So we're actually tactically shifting. Tactically, this isn't a wholesale call by any means. Energy exposure is still important, but shifting some of our exposure in energy back to materials, which have gotten oversold here, still in an uptrend, still look good, and playing that as kind of a way to shave off some of that exposure to these, what we think are overhyped, at least from a behavioral standpoint, into things that are oversold, but still in good trends.
There was, go ahead.
I should two comments to both these, because I don't entirely disagree. The one thing I wanted to say on the nonlinearity of consumer responses from Neil that I thought was interesting is I typically we were talking about demand destruction. I typically think of it in kind of two waves. So you've got the price, kind of the price elasticity of demand destruction, which, as Neil noted, is very, very low, particularly in advanced markets. There's no price too high for me not to drive my kids to school or drive to work. But then there's the income elasticity side as well. And what you typically end up seeing is that if this goes on long enough and you do get a recession, then you lose your job. Well, then you don't drive to work at all anymore. So it kind of goes like step change to down. So that's how I would expect this to happen as well. That in advanced markets, it's not the price, it's that income. It's that if that recession does occur and that kind of blows out, I think that's what's going to happen. But on the equity side, I want to say that I sound like, again, more bullish than I've ever sounded in my entire life, because I'm not normally a bull. So this is the moment right now, and I think I can't see it getting, I see it very, very bullish for the next couple of months in the second round. But I think that if the best parallel for this, I think, still is the 1970s shock, that's not bullish long term. I think what you've seen historically is all else equal, 10 years from now, already Asia will be consuming far less oil than it was if this didn't happen, because this has been an existential, terrifying shock for these economies, for these governments. I think everyone's been felt deeply, deeply kind of left in a lurch. This is how people felt in the 70s as well. And in the 70s, we saw the first real concerted effort to reduce global demand. There was a lot more low-hanging fruit there, power, oil and power gen, et cetera. But we did see a massive demand contraction, and that kind of spurred what we ended up seeing in the 80s, which was essentially a lost decade for oil overall. I think that we could very easily see something like that happen again today, because there's no better advertisement for the energy transition than blocking off a quarter of the world's oil coming from the Middle East. It will literally end up on every end oil placard from now until the end of time.
So Rory, let me ask you that on just real quick math here. If I'm looking at this right, you're looking at 12 months out, roughly $70, a little below that. Does that feel right to you? High, low, trajectory?
That feels low to me.
That feels low. Okay.
That feels like we're talking kind of a Brent or WTI basis 12 months out.
Yes.
Yeah, I still think that feels low. I think that, and I always typically think of the structure of the curve is not like the market's prediction for 12 months forward. I think the one of the big differences with physical commodities versus say like a rates curve is there is that physical physical clearance dynamic that's playing out here. So I think what this is really telling is that, well, I think that there could be opportunity to kind of get long, 12-month forward, because I do think that is probably cheap. I think lots of people probably feel the same way, but what's really happening is we're just bidding up the front so aggressively to incentivize every single barrel out of storage. And right now, you can basically, so when we were at our high on Monday, we had $9 backwardation, which was the most backwardated the front of the Brent curve had ever been in history. At that point, you could have basically sold your entire storage. You could have, bought it back in 6 months for a $30 arb, risk free. So that's what the market's trying to do, is it's trying to dump all these inventories out. But I do think that then if you are on the other side, I think it's quite compelling. Because I do think $70 seems too cheap still.
How long does it take to ramp up production? If I've got a well that's idle, and it's idle because it's not making me any money at $65 or $70, how long does it take me to get that to actually be producing barrels?
Yeah, so I think that would probably be what you would call like a stripper well or something like that, like these low productivity wells.
Wait,
you kind of
what?
ramp up. They're called stripper wells.
Sounds like a show. Easy.
So if you're watching Landman or something, and you see like a random kind of pump jack by the side of the road that looks like it's been there for 1,000 years, that's a stripper well. And basically what it means is that was once a very strongly producing well, and basically you're stripping that final, maybe it produces a barrel or two a day, maybe 10 barrels a day. That's actually a very price sensitive piece of the supply chain in the United States, because it's actually very expensive to produce those barrels, because logistics, because you're basically trying to power that single pump jack for 10 barrels a day and a bunch of water through the process. So that I think is where you could get some of that. But I think what we're really talking about in terms of a US supply response is more that kind of new production, and that I think is probably more like a 4 to 6 month window, which I think, again, if we're at that stage, any price signal a producer's receiving right now, if it's still needed in 6 months, it's going to be deeply, deeply out of date.
Is
so you're
there
going to be chasing that continually.
I know people throw this around, and I have no idea what it is. Is there an aggregate break-even rate on WTI? Right, collectively, what's that number that you see that says, "Hey, this is going to bring supply back on the market"? People will, So the $70 that I gave you, which is part of that curve, is that enough to make producers say, "Hey, we're going to, we'll fight the drug," I'm quoting Landman, "we'll fight the drug lords, the ex-wife, the crazy daughter, all that stuff, and get these things going again"? What am I looking at in terms of that break-even point?
70 would do it. I typically, there are a bunch of estimates and you can do it in a bunch of different ways. I think the easiest and safest way to do it, the Dallas Federal Reserve publishes its quarterly energy survey, and every January, they have an update to their basically break-even cost. So what would it cost to keep a well operating, and what would it cost to profitably start a new well? So if you're looking at that kind of profitably start a new well across the different basins, really you're talking probably, mid 60s. And I think that's probably right around right. At high 50s, we were seeing kind of early, even a couple months ago for WTI. That was at the stage of beginning to rationalize that. And we saw, my forecast turned flat to negative. We saw the EIA's forecast begin to turn negative for this year and next year in terms of growth. So I think that was roughly the pivot point of pain. We're clearly back in the kind of growth zone here. And the question will be, I think one of the big questions is, in this scenario, are you hedging? Because you can, like you said, you can hedge forward. You could basically lock in 70, and you're probably going to make money at that. But most oil people don't think like that. They think, wow, $100, $120, I'm going to hold on for that stuff. Because historically, oil producers, particularly in these kinds of moments, can get really burned by trying to kind of lock it in, and they miss out on all the upside. So I would say in an aggregate, they're probably more likely to kind of roller coaster chase the dragon here than they are likely to kind of hedge in production. I think the producers that will hedge in production are some of the more, the larger structured ones, the medium-sized independents in, the Permian Basin, the Occidentals, et cetera. They might hedge, but I don't think those smaller guys that are really going to be the kind of swing here will be as well.
So one of the other stories that was sort of banting around in the last couple of days was the possibility that the Treasury Department was going to buy oil futures or participate. So, Steve, first of all, to you, can they?
I think they probably could if they wanted to. I'm not sure of the legal justification for that. Look, right now you're seeing sort of there are a lot of things they can do. I don't know that all of them are really that impactful or meaningful. If there was a trump card, pun intended, they probably would have used it by now. Even tapping the SPR, I guess they were aware that they could do that. There were some reasons I don't think they really wanted to do that. One, it had been drawn down to about 60% because you had two political pressure points there. You had Biden using it ahead of the election for things that were more of a political emergency, and then Trump didn't want to raise the price or refill it because that would have raised the prices because of political concerns. I just sort of think of the SPR2 kind of like if you lose your job, you're sort of losing your source of oil here, just like you'd be losing your source of income at that point. So what do? You go to your savings, and it's not really sustainable. What you need is a new source of income. We need this source of oil to return. That's not really doing that. So I just don't really think that was an attractive option. I understood why they tried to do it, but somebody just doing basic math, we're on day 13 here. Rory talked about losing 20 million barrels a day. So people are assuming this is going to go beyond 20 days. And at that point, you've already gone through this. So perhaps that's why it was a pretty underwhelming response. I think Trump could do is he could potentially look at maybe putting some restrictions here on exports. But is that really attractive to try to incentivize these producers for a longer term? Would that jeopardize some of these trade agreements that haven't been ratified that included a lot of energy exports? So again, I'm not sure he necessarily wants to do that. We talked about relying on Congress, which is always a bad option if you're in the White House, regardless of who the president is, to try to remove the gasoline tax. Again, that's just going to make an already deteriorating fiscal condition worse. So I don't know that lawmakers really want to go down that route. And then what is this communicating? This is all communicating the opposite of what Trump's rhetoric recently has started to change a little bit from, is that, we're doing these things in anticipation of a longer conflict, a longer disruption. That's what the actions, in terms of actions speaking louder than words, convey. Versus you've seen a noticeable, I think, very noticeable change in Trump's rhetoric. Now, again, I understand he says a lot of things a lot of times, but what he's been saying more recently, and I'd say more consistently, is focusing on, how do you define politically what quote unquote success is, victory, whatever term you want to use. And he's been focusing more on the military actions. I think that's important because he's pointing to more tangible things as to we've degraded their military capabilities. We took out their leader. I don't know that the U.S. want to do that necessarily. We can talk about divisions there with Israel in a second. But to me, that sort of creates the conditions sort of to use the old George W. Bush analogy of mission accomplished, and you could sort of pull that back out. But I think what Rory touched on, I think it's true, is Trump may be looking now for that off-ramp. by claiming the military success. I don't think that's where Netanyahu is in terms of preferring regime change. Talk about Putin. Maybe Putin's the one that can broker the deal here. Who can Trump really negotiate with? You're laughing, Steve, but Putin may be that person to do that in terms of actually having some credibility there with the IRGC. I think that may have been, in hindsight, one of the missed or faulty assumptions here on the U.S. side, was not anticipating that Iran would close off their financial lifeline and choking the strait. And now that they have, again, that hindsight is 2020, but that may have been the faulty assumption there. That's it. I think Iran's made a faulty assumption too in attacking a lot of other countries there in the region. Because, if you think about longer term, what does that mean for them to exist in the region? I think, if anything, that's going to put them probably more closer to the U.S. position and distrustful of whatever ruling regime remains in place. I'm not sure if I answered your question, but I did go off on a tangent.
Steve, good job at blowing on the embers of Russiagate. Well done. Way to get that fire reflamed. Jesus.
Well, I just thought, we talked about stripper wells, we talked about, escort controversies.
Throw it in there.
I'm just trying to jazz up the things here. People probably had escort controversy on their bingo card for a second Trump term, but I don't think this is what they had in mind with respect to Wright's deleted tweets.
Really is off script, guys. I like it.
Talk about Trump's third term. Talk about that one and how that's how he's gonna fix it all in the third term.
Well, you better wrap this up quick and turn this economy around if he really wants to consider that. But to your point, whether you're trying to make it or not, is look, if this conflict doesn't go well, then that's not going to bolster the candidacies for J.D. Vance or Marco Rubio, because they're ultimately going to be associated.
Isn't Trump the only politician in America that can actually bear the political price of this because he's never going to have to face voters again?
Yeah,
100%.
But does he want to do that?
I don't care about your politics. I'm just going to say this. We cannot be seen as losing. It's just that simple. America cannot be seen as losing, because then you're basically going to give the Iranians license, carte blanche, to think that they can control the strait. And that is existential for the global economy, not just America, but a lot of our allies. So I don't know how much they thought about it all, what kind of wargaming scenario they did before they went in. But now that we're in there, you can't, that's the thing. I just feel like that's sort of my, I know it's I'm not, the one to talk about any of this stuff, but I just feel like as an American, you may not like what has happened, but we're in there. And if Trump is anything in his life, the biggest, sort of black eye on him is being labeled a loser. And, did you ever remember that time when he was campaigning and he went on Jimmy Kimmel's show, and Kimmel had this book in Dr. Seuss form?
Yeah, it's great.
Winners aren't losers.
Fantastic.
Hold on. It's honestly so good.
You don't have it for your kids? I thought you just pulled it off the bookshelf.
I did.
Right next to
Okay, here we go. I'm going to just read it. Winners aren't losers. They're winners like me. A loser's a loser. Which one will you be? Winners do deals and winners get rich, while sad little losers just sit there and bitch.
Oh, wow.
That's excellent.
This dog is a loser, and frankly, I pity it. This dog did bad deals. This dog is an idiot. Oh,
Pavin's got something to say, Dr. Seuss.
I was just going to say one thing that Trump hasn't said, and if you think about his prior criticisms of other presidents in the Middle East, was not taking the oil. And he hasn't said whether or not he tries to control some sort of oil here from Iran moving forward. And so you talk about, how is he going to define success? How does he want to be remembered, Neil? Maybe to your and Dr. Seuss's point. That's something to watch for. Does he sort of, look for some sort of, whatever the agreement is going to be moving forward, will the U.S. try to play some role in controlling this oil? No, I'm bringing it up because clearly controlling and being the dominant oil producer and swing producer is an important goal of his. And he hasn't said that, and I don't know whether they've just told advisors to say stop talking about the oil the way you did for Venezuela, because it's not a politically winning message, but whether or not he's still considering that or not. So,
one thing I will say here, the last thing I'll say, because I know that it looks like you're trying to wrap as well, but I will just say that the one interesting thing about what's currently going on in the Strait, do you know the one producer that's flow has not been interrupted almost at all? Iran. Iran continues to export oil full bore out of the Strait basically this entire time. A little blip at the beginning when everything was exceptionally explosive, but yeah. And yesterday, the IRGC basically said, like, if you take Karg Island, which is the main staging point for the vast majority of Iran's exports, then we start targeting port infrastructure in the Gulf next. So I think there is this kind of like brinksmanship here that, and to Neil's point, if Trump thinks he's going to win this and wait this out, we're going even higher than I thought we would, because I thought he'd buckle. Because I think the Iranian regime, well, obviously would lose long term against the U.S. military, can hunker down for a heck of a long time. They're preparing decades for this, and they can keep that. They can keep pressure on the Strait for months and months and months and months and months. And I don't know if the global economy can take it.
All right, and you mentioned the Strait, and I think you said this before, but it's never been closed. Even during the tanker wars, it's never been closed.
No, it's never. And just to put in perspective, and this is the thing, and to be clear, when this first happened, I didn't expect the Strait to be closed. I've been a Pollyanna on Iran and the Strait my entire career, because every perma bull has talked about it as the boogeyman, and I hate that. So I've always been Pollyannish about this. And during the tanker wars, as a reference, 1980s, this is the Iran-Iraq War, you had 450 ships, more than that, hit during that period, in the kind of period between the height of 84 to 88. 250 of those were tankers, and of those tankers, more than 50 were actually like sunk outright or scuttled. We're nowhere near that level of destruction yet, and during that period, tanker flow through the traffic through the Strait never stopped. I think one of the big differences now, though, is that Iranian capabilities, drones, and everything else are much better now than they were back then. So I think that's a differentiating factor. But still, I think we've never seen this. We've never seen this in the history of the Middle East. It's something that had always been talked about as a thought experiment, not actually seen and try and realized in real life.
Good stuff. Harry, good morning. Let's go to the mailbag, get a question in from one of our listeners. And I remind everybody, if you submit a question and we use it, we'll get you a trucker hat to wear during the spring and summer seasons, right? You'll be trucking oil around the U.S. if you need to. Harry, good morning.
Hi, good morning, everybody. We hope this war can finish as early as possible. And we have the question come from Eric Kroger today. His question is, what do you think of staples right now? I would think they would be doing much better if this is a true risk off market. What am I missing? That's it. Thank you.
Well, I think I should take that one probably. Staples, you would expect to do better because they're consistent, particularly if you go into a recession. You still use soap, not Steve Duttenhofer, but most of us still use soap on a daily basis, and Clorox and everything else, right? And they haven't done well. They've actually started to roll back over and underperform. I think really what you're looking at is, I think it was Eric, is the rally that we had at the beginning of the year. These were very oversold. It was a sector that was extremely oversold. It was actually flashing bullishly, contrarily in our SERM model. We didn't pitch it or suggest it to clients. We just kind of pointed it out because there was no momentum, and then it kind of started to really go in I guess it was the second week of the year, and then they got overbought. And about I'd say 3 weeks ago, they became kind of the classic overbought condition in a downtrend. So you had this confluence of short-term momentum with long-term weakness, and that's usually a bearish indication. And I think you're seeing the spit out of that. So the more traditional kind of areas that you'd think of, utilities doing well, healthcare mixed bag, but generally doing well. We actually had large cap pharma turn in our model this week, so for the first time in a long time. That was following, not leading, but following European pharma, following Japanese pharma, following Chinese pharma. So, you are seeing some indications of defensiveness do well. It's just not in staples. And so, the staple downtrend continues, the relative performance continues. And believe it or not, they're actually not that cheap. So there's not a lot there that's that interesting to us from a staples perspective. But thanks for the question.
Thank you, Eric, and we'll get you a hat for sure. Let's take a look at what we think is going to happen this week or what we're watching. Steve, I'm going to start with you.
Well, sure. So outside of Iran, a few things closer to home we're keeping an eye on. One is this housing bill. The Senate's probably going to pass it today, but it looks like the House has concerns. So that's a problem because the House concerns were supposed to be factored into the Senate bill. Some of it relates to this institutional restrictions, and it also relates to the central bank digital currency provisions. So if you were somebody trading institutional home buying names, this is something to watch because I think this is going to continue to go on. It also calls into doubt whether whether or not they're actually going to be able to land this legislative plane. So that's something to keep an eye on, and that may get continued into next week, which might bump into this Department of Homeland Security funding bill. If you're traveling right now, you may be experiencing long lines at the airport because TSA workers are now going to miss their first paycheck and they're starting to strike. So we may get some resolution there soon. The other thing to watch, if recording it Thursday morning, it looks like the Office of the United States Trade Representative has followed through on their threat to launch some Section 301 investigations into trading partners. This has been telegraphed for a long time. Remember, we talked before about the Section 122 tariff being a bridge until these investigations under other authorities, be they Section 301 or Section 232, those being the sectoral tariffs, could be conducted. We're looking again as that's July endpoint when the Section 122 tariffs unwind. Most of the targeted economies are ones we already had prior agreements with. So that's sort of the thing to watch. Is Trump just going to probably go back to what had been agreed to in terms of a tariff rate? So you can hold out the prospect of higher rates moving forward. We'll see what that means. But again, just more uncertainty being injected now. So probably not the greatest thing. Remember the timing too. China was added. Trump is going over to meet with Xi Jinping March 31st. So that's probably not a coincidence. So that's sort of a few things to keep an eye on next week.
Neil?
Well, since it's Thursday, we do have a lot of data coming out tomorrow, believe it or not. We do have PCE inflation. This is a January data point. We got the CPI number today. I mean, we didn't talk about the CPI number, but CPI inflation was generally on an improving track ahead of this geopolitical issue with Iran. That being said, there's specific details within the CPI that matter for PCE. And the main issue right now is that CPI inflation is looking a lot better because shelter prices are collapsing. But remember that shelter has a much higher weight in CPI than it does in PCE. And so that wedge that's being created, actually all else equal, makes CPI overstate the improvement in the inflation outlook. When you look at PCE, it's not as pretty of a picture. And that's why, unfortunately for the Fed, it kind of ties their hands because their preferred measure of inflation is going in the wrong direction. So I think that's important. We do get an update on core PCE tomorrow, and that'll be a January data point. We also get data on labor turnover. That's released tomorrow as well. So job openings, hiring, quits, and so forth. Look, the labor markets suck. Okay, I mean, there's no other way to talk about it. The labor markets are not in a good place. And at the margin, you have to ask yourself, are things getting better or are they getting worse? And, because inflation at the moment is tying the Fed's hands, that's their framework, right? That's their reaction function. It just basically means they need more of a permission structure in the employment data before they're willing to go. That's code for it needs to get worse. So by the time they start cutting, they may well be going aggressively, but there will be a lot more damage to both the capital markets and the unemployment situation before they begin doing so. We do get a Fed meeting next week on the 18th, and no one's expecting anything. People are probably going to ask Jerome Powell what he plans to do after his term is up and so forth.
Will he please say, I'm going to Disneyland? That would be fantastic. I will pay him money to do that.
But, look, I mean, he doesn't need to leave. It would be unusual for him to stay, given the fact that he's currently chair. But, what about this process has been normal? So it's always interesting when, it's the breaking of norms is asymmetric. I mean, it's at any rate. So that's what we'll be watching. That's it.
Jeff, you got the con.
I actually want to hear what Rory's watching. I mean, that's going to be the most important thing. Rory, what are the two or three things that are critical in terms of it getting better or it getting worse for you?
Yeah, so I think, so just looking at my, wire headlines right now, and Iraq's oil minister just about 10 minutes ago said that export operations have completely stopped out of the southern Basra fields. So that right there is 4.3 million barrels out of Basra that's now off the market entirely, at least before they were still filling tankers. So that's just going to get, I would say the only thing that really matters at this stage is whether or not we get any material uptick in traffic through the Strait of Hormuz. It's kind of like, that's the ball game. But as for things getting worse, things can always get worse, particularly in this kind of situation. I think this is, if we see further attacks against tankers in the region, I think every morning, like that's basically the routine now. You wake up and you're like, okay, well, how many tankers were attacked? And then I think, again, we still haven't had the full bore Iranian assault on infrastructure in the region. If you're looking for the real, true nightmare scenario, a couple of things we haven't talked about, there are some ways of deviating oil from the Strait. You have the East-West pipeline in Saudi Arabia that can export out of the Red Sea. That's actually a really important offset and probably potentially drops the overall flow impact from 20 to 15 million. That's a huge chunk, but it's still like the largest supply disruption in history. But that's a pipeline. The Iranians can still hit that. Right? If they bombed the East-West pipeline that's now currently filled with 5 million barrels a day of crude oil, that's pretty damaging. If they don't hit the pipeline, which parts could be harder to hit, you could hit pumping stations and basically render the pipeline non-viable. And if you hit other regional infrastructure, they've been hitting Fujairah, the Emirati port that also allows some exports around the Strait. That's obviously a major target. And the other thing that we still haven't fully seen is attacks on producing infrastructure. In 2019, you saw the attacks on Abqaiq, which is Saudi Arabia's largest crude oil processing facility for export, basically treatment and stuff like that. That it's like 9 million barrels a day of capacity and flow right through that facility at certain points. And yeah, if they hit that, that's a massive deal. And I think these are the types of things I've been likening it to, like the Strait of Hormuz at its core is kind of like a kinked garden hose. You can unkink it and the flow can resume. If you start hitting oil producing assets, that's not a kink anymore. That's taking a shotgun and then blasting off the faucet to which the hose is attached. Everything's repairable in the oil industry with enough time, but time is what we're rapidly running out of. And I think that's the situation. Every day that goes on, it's harder and harder and harder to restart the system.
Is there, just real quick, is there an indication of Strait of Hormuz traffic? I'm sure there is, but like those DOT things that you drive over? Yeah,
the trick and the tricky part about it, there's estimates that range, honestly. I've seen, some people are like it's one a day. I think probably we're at, Lloyd's List was listing at about 4 or 5 transits a day relative to about 100 to 120 prior to this. I think that's probably likely. You have some Chinese tankers, some Iranian tankers, and apparently some Greek ship owners are actually quite adventurous and risk-taking in this environment, and they've been making the run. But I think that is the challenge is that a lot of them, when they do make those runs, they turn off their AIS transponders. So you can't see them on the tanker tracking maps. So people have been tracking them visually, which is very hit or miss, particularly right now. This morning in the Strait of Hormuz, there's a giant cloud over the entire strait. So a lot of my tanker tracking friends are like pulling their hair out because they literally can't see anything going on down there. So it's one of these moments, like we have all this advanced technology, we have this AIS transponders, we have like deeply, deeply cool tools for tracking this, and then we get spoiled by clouds. And it's we're all very analog at the end of the day.
Jeff, what's on your plate? And then we'll wrap.
Well, we've got the oversold condition that we're looking for, right? So looking for those indications, clients know what those are. Looking for a shift in sentiment, kind of as my friend Walt Deemer says, when it's time to buy, you won't want to. We're certainly not at that moment yet from a sentiment standpoint. So I think we have to see more deterioration there. Three earnings announcements coming up that'll be interesting. Lennar's tonight, so it gives you some sense of what's happening in home builders. You'll have Dollar Tree next week. That'll give you some sense as what is happening at the consumer, particularly the lower end. And then you have Micron, right? And, I would say Lennar, the housing charts don't look good. They've started to deteriorate pretty rapidly here in the last 3 weeks, thanks to higher interest rates. The Dollar Tree chart actually looks okay, still in a good uptrend. It's getting oversold, but not there yet. And the Micron chart is just consolidating in obviously a pretty strong and vigorous uptrend. So that one's priced to perfection or getting there. So we'll see how that does. Oracle obviously had a good response in this last week. So we'll see if that can continue. But I think there'll be a nice window into the soul of what's happening to the consumer, and then just how viable and really how investors are willing to look at the bullishness of AI and compute, in the backdrop or with the backdrop of this war. So I think all that will be important.
Well, that was great. Rory, a real pleasure, I think, to have you on the podcast this morning. I don't know.
It's never good when people want to talk to people in oil markets. It's a good sign that everything's deeply, deeply breaking. But I appreciate having me on. Thanks so much for having me, guys.
I literally was going to say you're welcome back anytime, but when we have you back the next time, it's going to be a disaster. So I would draw listeners' attention to commoditycontext.com. It's where Rory has all of his great stuff. It is a great site to find out what Rory's thinking is. So I direct you there. Certainly you can follow us on X. You can follow us on LinkedIn. But we'll be back next week without Rory, but we'll be back talking about the markets. Until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Pavlik.
And I'm Rory Johnston.
Thanks so much, Rory. Have a great week, everybody.
Thank you.
Hey, it's Steve. Thanks for listening to the show. Small slice of what we do here at RenMac. So if you liked it and aren't already a client, go to renmac.com and request a free trial. You get access to all the political, all the macro, all the technical, and all the economic work we do here, plus screens, alert lists, and all the research behind the wall. Work at a financial institution or just an individual, we have the edge you need. So join us here at RenMac. We'd love to have you part of the team. And don't forget to follow us on X, LinkedIn, and YouTube. Thanks for listening to the show.